Alrighty. So in today's video, I'm going to be sharing with you a very interesting strategy, and I'm pretty sure that this is a strategy that you do want to implement and one that you'll be very interested in. Why? Well, it's because this strategy is 100% risk-free. There is absolutely no risk in this strategy, and this is not a scam, right? This is 100% legit strategy that you can actually put on that takes away all the risks that you have, which means to say there is no capital risk at all for this option strategy, right? So what is this 100% risk-free strategy? And in the first place, is it really even possible? Well, let's find out together. So what is this strategy? This strategy is none other than the 100% risk-free butterfly, right? So if you guys are familiar with the butterfly, I'm sure you know that the butterfly do have some risk, although the risk reward is, pretty good, right? But you still have some risk. So you might be wondering, how is it possible to have a 100% risk-free butterfly, right? So for this strategy, I have some good news and some bad news, right? So the good news is that this can definitely be done, right? So it's 100% legit, 100% risk-free. If you can put it on, then you have eliminated all risk from the trade, right? But the bad news is that there is a condition that has to be met in order for you to be able to construct the 100% risk-free butterfly, right? So it's a little bit like you have to nurture it. So just imagine this, right? When you first start it off, it has to be like a caterpillar, right? So in case you're not sure what I'm doing right now, I'm actually drawing a caterpillar. Definitely doesn't look at it right now, but I assure you it is a caterpillar as long as my grade 1, artistic skills actually show. So this is a caterpillar, right? Caterpillar with eyes. No, it's not a centipede. It is a caterpillar. So it starts off as something like a caterpillar, and in order for it to become a 100% risk-free butterfly, certain conditions have to be met. Then it will become a beautiful risk-free, 100% risk-free butterfly. So this is a butterfly, and wow, I'm pretty impressed with my butterfly, right? It looks pretty good, right? Definitely much better than the caterpillar. So how do you know this is a 100% risk-free butterfly? Well, you have to look at the wings, right? You need to see whether the wings actually say 100% risk-free butterfly, right? So if you see a butterfly in your garden, right, and it flies by and you see that on its wings it has 100% risk-free butterfly written on it, catch it, right? Because this is how you actually construct the 100% risk-free butterfly. All right, so enough nonsense. So how do you create a 100% risk-free butterfly? So the thing is that for you to get into this construct where there's absolutely no risk for the butterfly, it doesn't actually start off as a butterfly, right? So remember, I shared with you the picture. It starts off as a caterpillar. So what is this caterpillar? Well, this caterpillar is basically the put ratio spread. So you have to put on a put ratio spread first, where there's going to be some risk, obviously, right? Because the put ratio spread is not a risk-free strategy, right? So you have to start off with a put ratio spread. And if you're not familiar what the put ratio spread is, it's basically just two short puts that is very far out of the money and one nearer, long put option, right, slightly closer to where the market is, right? So again, if you want to think of it in a much easier way, it's pretty much a short put, right? Imagine this two short put, you split up. It's pretty much just a short put that is financing a put debit spread. So you have one long put and one short put. So down here, this is the put debit spread, right? So this is the put ratio spread. You have to start off as a put ratio spread first. So as an example, let's say you sold the 190195 put ratio spread for $1.44 credit, right? So this is the first step. Now, the second step is that you want to select the further out of the money put that is equidistant from the other long put. So what you're trying to do here is now you're trying to convert it into the butterfly, right? So remember, the butterfly is nothing more than the defined risk version of the put ratio spread. Now, in order to convert it into this risk-free butterfly, then you need to select the out of the money long put that is equidistant from the other long put, and this is very important. So what do I mean by equidistance? So for example, this is the distance, or rather the spread of the put ratio spread that you put on, right? As you can see, it's 5 points wide from 190 to 195. So for you to get an equidistant strike, then on the other side, you also need it to be 5 points wide. So 190 minus 5, that is 185. So what you're doing is that you are capping the risk all the way to the downside, so to speak, right? Basically, you are turning it into a butterfly with this long put. Now, why is it important to make it equidistant? Right, it's important to make it equidistant because if you were to choose the 184 strike, let's say you choose the one that is 6 points away, now it's no longer 100% risk-free because now you're going to get some risk. Remember, the whole structure of this butterfly, the profit is basically what you get down here, right? The profit is based off this debit spread that you have, right? It's the embedded debit spread of this whole structure. And then the max loss down here is basically also the width of this spread that you have on the downside. So basically what you have down here, this is the credit spread. This is the debit spread. So the max profit or debit spread is going to be $500 because it's 5 points. So if it's equidistant, then the max loss is going to be $500 as well. So anything past 185, there's no risk. But if you choose 184, now suddenly you have a 6-point wide credit spread on the downside. And what that means is that your max profit from your debit spread, which is only $500, cannot cover the max loss of the 6 points, which is $600. Right, which means to say there is going to be a risk of about $100 on the downside. So if you want to craft one that has 100% risk-free, then you definitely want to choose an equidistant strike, basically the same width as the embedded debit spread of your initial put ratio spread. Next step number 3, also a very important one, and that is to place a limit order to buy that put option for less than the credit that you receive. So here's an example. So you place a limit order to buy the 185 put for $1.40 or less. So very important, right? So you want to make sure that when you are placing the limit order, you're buying it for less than the credit that you receive. Because if you were to put it more than the credit that you receive, then it's no longer going to be a 100% risk-free butterfly, right? There's going to be some risks, right? It's just like, for example, your wife asks you to go down to the convenience store or the grocery store to ask you to buy something, and she tells you that, her budget is $50, see whether you can get it for lesser than that. But instead, you go to the grocery store, and instead of just using the budget of $50, you see so many other things that you want to buy, and you end up buying a total of over $100, right? So you go back to your wife and you tell your wife that, instead of spending that $50, you spent over $100. And that is when your wife is going to do to you what most options generally do, and that is to make you expire worthless, right? So if you do not want your wife to make you expire worthless, then guess what? You need to be a man, do the right thing. Make sure that you spend within the budget that she gave you. And in fact, if you buy much lesser than the budget she gave you, she's going to be so happy that not only is she not going to make you expire worthless, she's probably going to roll you to the next expiration date, right? So she's going to keep you around for much longer and keep rolling you. And the best thing that, you've made it, right, is when your wife has actually rolled you into a leap. So if she rolled you to a leap, then you have, 1 to 2 years of free time, basically, right? And basically you can do whatever you want until the time comes where you're going to expire worthless again. You better be sharp and not do anything to anger your wife. All right, so basically the point here is that do not, pay more than whatever the credit that you receive down here. Okay, so if you want it to be 100% risk-free, just make sure that whatever you're buying that long put for, it's less than the credit that you receive for the put ratio spread. Now, the final step number 4, basically you've already done all the work, right? You sold the put ratio spread, you've already selected the equidistant long put, and then you place a limit order that is less than the credit that you sold it for, ensuring that it's going to be risk-free. Now, all that's left is to pretty much just wait until you get filled, right? So if you get filled, then congratulations, this is where you now have a 100% risk-free butterfly, right? So I'm going to give you an actual example to show you one of my trades that I converted it from a put ratio spread to a 100% risk-free butterfly. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. Right, so as you can see down here, this is a put ratio spread that I put on. So I sold the 183/189 put ratio spread for a credit of 32 cents, right? So I'm going to receive $32 in terms of premium upfront. So as you can see down here, this is the structure of the put ratio spread. So again, this is where the short put is at, the 2 puts down here, and then the long put is over here, right? You have the 1 long put, and this is where the current market price is. So as you can see, whenever we are putting on the put ratio spread, we want the put ratio spread structure, generally I like it to be below where the current market price is. Basically this tent down here, from this point to here, I want this tent to be below where the current market price is. Now, the next step, as you know, is to identify where this equidistant long put is, right? So as you can see down here, the put ratio spread that I have on is 183/189. So that is 6 point wide. So where do you think that equidistant long put is going to be? It's going to be 6 point away from where this short strike is. So this short strike down here is 183. So I'm looking for one that is 6 points away, right? 6 points away. So what is 6 points away from 183? The answer is 177, right? So I need to choose the 177 strike, the long put over there, to pretty much just build this 100% risk-free butterfly. So after some time, the equidistant long put at 177, which is 6 points away from the short put, as I mentioned, is now marking at 25 cents. So at this point, let me ask you this question. Does it look like we can put this on for a 100% risk-free butterfly? Well, the answer is yes, because now I'm buying that put option, which is lesser than the credit that I receive upfront, right? So as you can see down here, right now, I am able to construct this put ratio spread, turn it into a 100% risk-free butterfly, right? So that's exactly what I did. So I bought it and I got filled for 1 cent better. So basically I bought it at 24 cents, as you can see down here. So what does this mean? It means right now, I pretty much have the 100% risk-free butterfly put on. And in fact, you notice that there's absolutely no risk whatsoever on both sides, right? You can see down here, this is the $0 P&L level. You can see that the line down here is actually above 0, right? So we have 2 points down here, this point and this point down here, which means to say that if the market settles anywhere past this point or below this point down here, then I'm just going to get the minimum profit. So what is the minimum profit? The minimum profit is basically the difference from the credit that you receive upfront and what you purchase the long put for. So if my maths didn't fail me, then you can see that the difference is 8 cents, which means to say there is a minimum profit of $8, right? If it goes past this point down here or it goes past this point over here. So as you can see, not only do I have no risk on the structure, I actually have a minimum profit. And the best thing is that if the market actually trades down to somewhere inside this 10 at expiration, okay, so basically this is where the current market price is. If you cannot see, all right, this is where the market price is. Now, if the market trades down and it lands somewhere around here at expiration, then this is where I'm going to get much more than the minimum profit. And if it doesn't reach inside here, then guess what? At least I still get some profit. So by buying the equidistant long put, I now have 100% zero risk. Right now, it is 100% risk free. I have a minimum guaranteed profit as well, as I mentioned, because that's the difference between the credit you receive upfront and what you bought that long put for. And now you have your buying power reinstated, right? Your buying power requirement is no longer used for this trade because you have pretty much turned it into a risk-free. So whatever that was stuck previously for putting on this trade has now been released, and now you can put on another trade that you want to, and this structure is still on. Right, this structure is still there for you for the possibility that the market can trade inside here and you can make much more than the minimum profit. So imagine this. Imagine where you have reached the point where you have put on so many of this 100% risk-free butterfly that, you know, as long as the market trades to any one of those butterflies, it's going to have a chance for you, you know, to make the profits that is somewhere inside this tent. Now, at this point, you might have a question, or maybe you might not, but I want to bring this question to your attention is, you know, what is the cons of actually, you know, turning the put ratio spread to a 100% risk-free butterfly? Because as you know, I love my put ratio spreads, right? So if you were to turn it into a 100% risk-free butterfly, is there any catch, right? So the only thing is that, number one, first of all, you may not actually have the chance to turn it into a 100% risk-free butterfly because it all depends on whether this down here can actually go down to below, you know, the credit that you receive upfront, right? So if you receive for 32 cents, you need to wait for that equidistant long put to actually drop below 32 cents for you to convert it into a risk-free butterfly. But let's say, for example, if the market trades down from the moment you put on the put ratio spread, then chances are this price down here, this long put, is going to be increased, right? It's definitely most likely going to be much more than 32 cents because now that put option is going to be slightly closer to where the current market price is as the market trades down. So it's not always that you can actually construct, you know, every put ratio spread and turn it into a 100% risk-free butterfly. It really depends on the underlying, and also, you know, whether the decay is fast enough to reach a point where it's lesser than the credit. So that's the very first point. Now, the second point, let's say, for example, you are actually able to turn it into a risk-free butterfly, then the cons, or rather the thing that you're going to give up, is pretty much just this credit down here, right? So this amount, you have to actually pay for it, right? It's 25 cents, which means it's $25. What it means is just this, right? So this is where the current market price is, okay? This is the market price. So let's say, for example, if you put on the put ratio spread and the market actually stays above around here at this point, or maybe the market goes up, if you did not actually buy this long put for 25 cents, then you would have actually gotten the full 32 cents in terms of the premium you receive upfront, right? So it's a $32 profit for you upfront. But because you've actually bought this long put, then you have given up $25, which means to say if the market just stays somewhere down here, right, basically above where your tent is, then you're only going to get roughly about $8, right? 8 cents. So that is pretty much the only con that you're going to have for converting the put ratio spread into the 100% risk-free butterfly. Alright, so this is how you get a 100% risk-free butterfly, and if you like this video, I greatly appreciate if you give me a thumbs up on this video. By the way, if you like this video, then you're absolutely going to love this next video which I have for you, so go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen and you'll be able to get it for free. Alright, I will see you in the next video.